what the heck is earnest money? And is earnest money refundable? In what situations can the seller keep your earnest money? Well, we're going to talk about all things earnest money in today's video. Hi, I'm Charlotte with Birch & Cedar Realty Group. Earnest money is a deposit. It's typically 1 to 2% of the purchase price, and it's used to show your intention on buying the seller's property. It shows that you have some skin in the game and that you're not likely to back out willy-nilly. Now, the buyer has a couple of options on how to provide this as earnest money. You can either pay personal check, cashier's check, money order, or even wire transfer. And you have a certain number of days in order to get this money into the right account. It's either going to go into the brokerage's escrow account, or it's going to go straight to the title company. These funds are used towards your transaction, towards your purchase price. So they'll count towards closing costs or down payment if you have a loan. There are certain scenarios in the transaction where you can actually cancel the contract and get your earnest money back. Those are typically called contingencies, and there's usually about 3 of them. You're going to have your inspection contingency, your appraisal contingency, and your financial contingency. So basically what this is after you go under contract, you have a certain period of time to have an inspector come out and look at the house. They're going to look at everything from the attic, the crawl space, plumbing, landscaping, things like that. And they're going to generate a report that shows different things that need to be repaired or replaced. Now, 2 scenarios can happen. One, you can take a look at that report and decide you don't want to move forward at all, and you can cancel the contract and get your earnest money back. So that's one option. But let's say that you want to ask the seller to replace or repair certain items. You can send them an addendum and ask them to do that, and they can actually say, yes, we'll repair some, or no, we're not going to repair any, or yes, we'll replace or repair all of these things. Now, if they come back and say that they don't want to do it all, or they don't want to do any, you have the option at that point also to cancel the contract and get your earnest money back. So an appraisal is actually done if you are getting a loan on the property, and the lender's going to require, usually, with few exceptions, that an appraisal be done. And that's an independent party. They'll go out and they'll look at the home and do comparables for other homes in the neighborhood and in the area and determine what that home is worth. Now, if it appraises for what your purchase price or offer was, great, then we're golden. But if it doesn't, then you can either pay additional money to cover the difference, the seller can actually lower the price so that it matches the appraisal, or you guys can decide to cancel the contract and you as a buyer would get your earnest money back. The financial contingency allows you a certain period of time to ensure that you can get a loan funded in order to purchase this home. Now, it is there, and you do have a certain period of time to get that loan set up, but I will tell you that in a seller's market, you're actually going to want to have this done way ahead of time, because a lot of times sellers won't even consider your offer if you don't have that pre-approval taken care of. I have done a video on pre-approval and pre-qualification, and I will link that here, so check that out if you have questions about that. One reason is that they don't want to take that home off the market only to find out in a couple of days that you actually can't qualify for a loan. By taking it off the market, they lose valuable marketing time and prevent an actual qualified buyer from buying it. Now keep in mind, this contingency is there for a couple of days for you to get your loan figured out and approved. Once you have that approval and you moved past that, let's say 5 days before you're supposed to close on the home, you go and buy a bunch of furniture or buy a car, and then the lender goes to do the final check and you no longer qualify, you're going to lose out on your earnest money and you're not going to get the house. So bonus tip, wait until you get those beautiful keys in your hands to do anything that can affect your credit. Basically, if you default on any part of the contract, the seller gets to keep your earnest money. Let's say, for example, you passed inspections, and then later on you thought, I really wish they would have repaired this. I don't want to buy it without that. Well, you're defaulting, and they're going to get to keep your earnest money. The same thing when you've gotten your loan approval, and you go and buy that furniture or that car, and it affects your credit and affects your financial status, they're going to get to keep your earnest money. If you think about it from a seller's perspective, it actually makes sense. They now have to remarket that home, and they've lost valuable marketing time and potential buyers that would have purchased it. most likely their future plans are dependent on this home selling. So now they have to start over. From their perspective, it makes sense. The purchase and sale contract is just that, a contract. So when you sign that contract and you say that you intend to buy that home, you're legally obligated to do so with the contingencies in mind. I hope this was helpful. If you have more questions, leave a comment below. And as always, like, subscribe, and click that little bell. Thanks so much for watching. See you next time.